Welcome to the Deep Dive. We cut through the noise to get you informed fast.
Today, we're really digging into something that's, well, it's all over the news.
Yeah, especially with all the recent headlines mixing cryptocurrency, big money, and political figures. We're talking conflicts of interest.
That critical point where personal wealth meets public duty, and now increasingly where new tech like crypto comes into play.
Exactly. Our mission today is to give you a real shortcut to understanding this. What are conflicts of interest, really? Why should you care? And how is this whole area changing, especially with digital assets?
And we're drawing on some serious research here. We've got European Parliament briefings, detailed U.S. Congressional Research Service reports, recent financial news analysis.
It's a solid stack. And all of it has been carefully pulled together and, curated by our fantastic research team, Expert Trader UK, just to bring you the absolute key takeaways.
Right. So by the end of this, you'll get the core ideas, but also hopefully understand the why behind the headlines. It's about empowering you, really.
Okay, let's dive in then. Conflicts of interest. We hear that phrase constantly, but what is it fundamentally?
It's a great starting point. Basically, the widely used definition frames it as a set of circumstances that create a risk.
A risk of what?
A risk that professional judgment or actions, regarding a primary interest like public duty will be unduly influenced by a secondary interest, often a private one.
Like money.
Often, yes. Financial gain is a big one, but it's broader, too. It's connected to corruption. It's even mentioned in the UN Convention Against Corruption.
Okay, but it strikes me it's not always about, like, a brown envelope stuffed with cash, is it? It feels more potential sometimes.
Absolutely. That's a key point. It's often about the perception and the potential for bias. Conflict of interest laws are often described as preventative or prophylactic, meaning they aim to stop undue influence before it happens, even subtle, maybe unconscious influence. The OECD, that's the Organization for Economic Cooperation and Development, they talk about different types.
Oh, yeah. Like what?
Well, there are actual conflicts where there's a direct clash. Then apparent conflicts where it just looks bad, it raises questions, even if nothing improper actually happened. And potential conflicts where a private interest exists that could realistically lead to a conflict down the line.
I see. So it's about managing that risk, even the appearance of risk.
Precisely. It's about maintaining public trust.
So what kinds of interests are we usually talking about here, and where do these conflicts tend to crop up most often?
Good question. We generally split them into two buckets. Pecuniary interests, that's the financial gain stuff we mentioned, and non-pecuniary interests.
Non-financial, like what?
Yeah, things stemming from personal relationships, family ties, professional affiliations, that sort of thing. And as for where they pop up, Transparency International highlights a few common sources in OECD countries.
Okay.
Things like secondary jobs in the private sector while holding public office, private-public partnerships, which can get tricky, and owning shares in companies that do business with or are regulated by the government.
Right, that makes sense. Understanding these basics really sets the stage, doesn't it? It helps you see why managing these intersections is so critical for, well, trustworthy government.
Absolutely. It's the foundation. And knowing that, let's look at how the U.S. federal government tries to tackle these potential financial conflicts.
Okay, how do they approach it?
In the executive branch, there's a framework often called the 3D scheme. It stands for disqualification, disclosure, and divestiture.
The 3Ds, okay.
Yeah. And the core principle behind it all is this idea of undivided loyalty. A public servant is expected to make decisions based only on the public interest, not their own financial situation.
Undivided loyalty, that's a high bar. So if I'm, say, a government official and a potential conflict comes up, what's the first D? What do I do first?
The first line of defense is disqualification, or what most people call recusal, stepping away.
Just bow out.
Pretty much. There's a specific federal law, 18 U.S.C. Section 208. It's actually a criminal statute.
Criminal? Wow.
Yeah, it means officials must disqualify themselves from participating in any particular matter where they, their spouse, their minor child, or certain organizations they're linked with have a financial interest. Fail to do that, and you could face charges.
Okay. Does that apply to everyone?
Well, interestingly, that specific law, Section 208, explicitly excludes the president and the vice president.
Okay. Any other exceptions?
Yes. The Office of Government Ethics, the OGE, has rules that exempt what they call de minimis interests, basically. Stuff considered too small to likely cause a problem.
Like what? A few shares of stock?
Kind of. Things like owning diversified mutual funds or holding a relatively small amount of stock in a big publicly traded company. The threshold changes, but the idea is it's unlikely to sway a major decision. But recusal still applies to what's called personal and substantial participation.
And particular matter, does that mean just like a specific contract?
It can mean a specific contract or investigation, but it can also be broader. It can cover things like developing regulations or policies that affect an entire industry if you have a stake in that industry.
Okay, so recusal is step one. What about the second D's disclosure? How does the public actually find out about these potential conflicts?
That's crucial for transparency, right? The main tool here is the Ethics in Government Act of 1978. It mandates annual public financial disclosure for senior officials across all three branches, legislative, executive, and judicial.
Annual reports, what's in them?
They have to report quite a bit. Their assets, stocks, bonds, mutual funds, any property that generates income over $1,000, savings accounts over $5,000. Also, any outside income they earned, significant gifts they received, liabilities over $10,000 like big loans.
So debts too.
Yep. And also financial transactions buying or selling assets over $1,000.
Then there's the Sestober Act.
Right, I've heard of that one. That added a requirement for more frequent reporting, specifically for transactions involving stocks and bonds. Officials covered by it have to report those trades within 30 to 45 days.
Vaster updates.
Yeah, though it doesn't typically apply to buying or selling diversified mutual funds or most ETFs. And it's worth mentioning that lower-level employees whose jobs might still involve conflicts usually file confidential disclosures, not public ones.
Okay, so recuse yourself if needed, disclose your finances publicly if you're senior. What's the third D? Divestiture. That sounds like getting rid of stuff.
Exactly. Divestiture means selling off assets that pose a conflict. Sometimes it's outright required by law.
Can you give an example?
Sure. Members of the Federal Reserve Board, for instance, are legally barred from owning stock in banks. Or an agency might have its own specific rules, like the SEC, the Securities and Exchange Commission prohibits its employees from owning stocks or bonds in companies it regulates. Divestiture also comes up frequently as a solution during ethics reviews. An official might enter into an ethics agreement where they promise to sell certain assets to resolve a potential conflict. Sometimes there are even tax benefits, like deferring capital gains tax to make it easier.
Any alternatives to selling?
Well, the main alternative sometimes used is a blind trust. That's where you put your assets into a trust managed by an independent trustee, and you, the official, have no knowledge or control over how they're managed. The idea is you can't be influenced by assets you don't know you hold.
So disqualification, disclosure, divestiture, that's the framework. It sounds pretty comprehensive on paper.
It is a framework, yes. But, its real-world effectiveness is always up for debate. Influence can be subtle, power structures are complex, and sometimes regulations lag behind new realities.
And maybe part of the challenge is that this very line between public duty and private interest, well, it hasn't always been drawn in the same place, has it? History kind of shows us it shifts.
That's a really insightful point. The sharp distinction we often assume between the public sphere and the private sphere, it really solidified in the 16th and 17th centuries.
With the rise of modern states.
Exactly. Hand in hand with ideas about the nation state and individual rights. Before that, things were much blurrier. Think about medieval England. The king's lands were simultaneously his private property and the public domain.
Huh. I never thought of it that way.
Or even taxation. For a long time, it was seen more like a private gift from subjects to the ruler, not really a public obligation enforced by public law. That changed as ideas of sovereignty developed.
So things got clearer for a while? Or tried to?
Well, yes and no. The 19th century saw a big push to really separate public and private law. Contract law, for example, was viewed as this purely private domain. Government shouldn't interfere.
But that didn't stick.
Not entirely. In the 20th century, especially with the legal realist movement in the U.S., thinkers started pushing back. They argued that all law, even private law like contracts, is backed by state power and has real-world consequences for how wealth and power are distributed. There's no truly neutral private sphere.
So the line gets blurry again.
It does. And especially after World War II, you see this shift where the state's role changes. And frankly, private self-interest becomes a more dominant force in shaping policy. Understanding this back and forth really helps you appreciate why navigating these issues is still so tricky.
Especially, I imagine, when you throw something totally new into the mix. Which brings us right up to today and cryptocurrency. How does this rapidly evolving world fit into this picture? It seems custom-made to blur those lines.
It absolutely does, and the scale is just huge now. Look at the U.S. market for Bitcoin spot ETFs, exchange-traded funds. The inflows this year, 2025, have already blown past the 2024 numbers for the same period.
Really? How much are we talking?
Over $14.8 billion in cumulative net inflows just this year so far. Our research team, Expert Trader UK, pulled that data from recent financial reports. It's a clear signal that digital assets are going mainstream. And it's not just Bitcoin. Ethereum spot ETFs are booming too.
Okay, so crypto isn't niche anymore. It's big money becoming part of the establishment, and that inevitably means it's colliding with political power, right? Creating new potential conflict zones.
Precisely, and we're seeing that play out very publicly. For instance, there's been significant attention on a prominent political figure whose company recently updated its ethics agreement.
What changed?
Well, the new agreement reportedly allows the company to strike deals with private foreign companies. This is a major shift from the policy during his first term, which barred deals with both foreign governments and private foreign companies.
And ethics experts are concerned.
Yes. Concerns have been raised that this could potentially open the door for foreign entities or individuals to gain influence. The worry is about massive influxes of cash, as some put it, flowing into the company's ventures, which include Trump Media and also a new cryptocurrency venture called World Liberty Financial.
And does this connect to any existing rules?
It does. The analysis our team at Expert Trader UK looked at specifically mentioned how this could renew debate around the Constitution's emoluments clauses. Those clauses restrict federal officials from accepting payments or gifts from foreign governments. The question now is whether deals with private foreign companies might be seen as a way around the spirit, if not the letter, of those rules.
It's a complex legal and ethical question, and it's happening alongside a broader shift in stance on crypto itself from this figure, right?
A very notable shift. He went from saying he was not a fan of Bitcoin back in 2019 to now actively courting the crypto industry, promising to make the U.S. a global hub, appointing known crypto advocates to potential key roles.
Which raises questions about regulation.
Absolutely. The SEC, for example, under current leadership, has frequently warned about crypto's volatility and the lack of investor protections. How vigorously the SEC or other agencies might scrutinize the industry could definitely change depending on who's in charge.
It's definitely not just about one person or a company, though. What about Congress itself? Do members hold crypto? Our Expert Trader UK team looked into this too, I believe.
They did. And it's perhaps surprisingly limited, given how widespread crypto ownership is now among the general U.S. population, nearly 40% of adults, according to some surveys.
So few members of Congress hold crypto.
Very few have publicly disclosed it. Remember, the Stock Act requires reporting crypto transactions over $1,000 within 45 days. But the data shows only a handful have reported trades recently.
Who, for example?
Since 2021, reports indicate only 2 current House members bought crypto. Michael Collins, a Republican from Georgia, and Barry Moore, Republican from Alabama. In the Senate, only Ted Cruz, Republican from Texas, has reported trading crypto.
Anyone get rid of it because of potential conflicts?
Yes. Jeffrey Jackson, a Democrat from North Carolina, explicitly stated he sold his crypto holdings when he entered Congress to avoid any appearance of conflict. And there have been controversies. Former Rep. Madison Cawthorn was penalized related to a crypto token he promoted.
Interesting. So not widespread holdings, but Congress is starting to legislate more in this area.
Definitely. There's been recent movement. For example, the Genius Act, that stands for Guiding and Establishing National Innovation for U.S. Stablecoins Act, was recently signed into law.
Stablecoins, those are the cryptos pegged to regular currency, right?
Exactly. Pegged to things like the U.S. dollar, backed by reserves like cash or treasuries. The Genius Act aims to create a clear regulatory framework for them, focusing on consumer protection, ensuring they're actually stable, fostering innovation, and also supporting the dollar's role globally. There's also the Clarity Act being discussed, which deals more broadly with the market structure for digital assets.
It feels like the rules are trying to catch up with the tech.
That's a perfect way to put it. The speed of innovation here is constantly testing those traditional conflict of interest frameworks we talked about. It just makes transparency and your own critical awareness more important than ever.
Absolutely. So, wrapping this deep dive up, what are the key things for you to take away?
Well, first, understand that conflicts of interest aren't always obvious corruption. They're often about the potential for private interests to unduly influence public duties. It's a risk management issue at its core.
Right. And the U.S. uses that 3D framework, disqualification, disclosure, divestiture, to try and manage those risks, though its effectiveness is debated.
Exactly. We also saw how that fundamental line between public and private isn't fixed. It's shifted historically, which complicates things today.
And finally, the rise of cryptocurrency is throwing a whole new set of challenges into the mix, creating new potential conflicts for public figures, prompting new regulations, and testing those old frameworks in completely new ways.
Understanding all these dynamics, the definitions, the rules, the history, the new tech, it's really vital for just being an informed citizen, for making sense of the news, and maybe even for your own financial decisions in this interconnected world.
Yeah, it really makes you think. As these lines between public service and private gain keep getting redrawn, especially with tech like crypto moving so fast, what does ensuring impartiality in our leaders truly require? And maybe more importantly, who ultimately holds the responsibility for making sure that public trust is maintained? Something to keep mulling over.